Welcome to the panel discussion on how trade, dollar dominance, and debt intersect to shape global policy choices. I'm Beth Baltzan, a fellow at the GeoEconomics Center at the Atlantic Council. With me today, Senator Tordoir, chief economist at the Center for European Reform, and Charles Lichfield, also my colleague at the Atlantic Council GeoEconomics Center. Charles, let me start with you on this subject. One of the things that we see happening is a move away from the silos that have tended to dominate the conversation for the last 40 years, and in a sense getting back to that original thinking that informed Bretton Woods back in 1944, that all of these areas are connected. So how do you look at this issue? How do you look at the issue of global imbalances, for example, as a cross-cutting
Thanks a lot, Beth. Yeah, first of all, on the silos breaking down, I think you're absolutely right. And it's a mistake that we've made over the past few decades to forget that the trade setup, or thinking about trade and equitable trade, was there when the original thinkers of Bretton Woods were there. And quite often, the two institutions that we're all talking about this week are very much associated with Bretton Woods, the trade component less so. And it's good that we've tried to re-establish this. I think it dates back. There are a few moments where we've had realizations that it's important. The pandemic is one, beginning of the war in Ukraine, the work you were doing in the administration. All of these have brought these issues back in sort of connection, but I think, yes, the silo was there, and that's unfortunate. Why are we all talking about global imbalances? I think to some extent we have to accept that it's not just academic. There's a sort of diplomatic reason why we use this term. It's easier to talk about global imbalances than unfair trade practices. It's easier to talk about global imbalances to bring notional allies together and get a discussion going on China. So the US and France have presidencies, the US of the G20, the France of the G7 next year. They have a lot to disagree about, and the US has imposed tariffs on the EU, which the EU isn't too happy about. They've accepted this deal. The reason they can at least find an understanding on global imbalances is that the perception that the data isn't good enough, so we need to work on the data, that China is a problem, although it's difficult for the EU to call it a problem, and therefore couching it in this more diplomatic language of global imbalances is easier. So that was for the diplomatic reason why we're doing it this way. And then on the academic side, I mean, Sander will come in as well, but it is true, and this has been proven by economists, that when you have huge trade surpluses that are persistent for countries like China, it does create national security problems, it does create financial instability problems. And then we found, bringing it back to the war in Ukraine, which is now sadly almost at 4 years, we found that it's very difficult to sanction countries with persistent current account surpluses. So I know we're going to be talking about the dominant position of the dollar, and that for now is uncontested, but it isn't that useful actually when a country has a persistent current account surplus. Financial sanctions for a country that needs to borrow, that can be very effective. A country that keeps pulling in income is very difficult to sanction. We've seen it with Russia, and then it is in the ether about China. So I think that is another reason why these issues are things that we're talking about. But I don't want to sugarcoat it. The data isn't very good, especially when it comes to China. There's disagreements between the US and Europe on exactly what the problem is. So we'll discuss all of that now, but I think that's basically the cluster of issues.
That's really helpful, Charles. And it's easy to forget that in 1944, the plan was set up the World Bank, set up the IMF, make sure that you've got a monetary regime, and then once you've done all of that, you can turn to trade. So these issues were connected to each other, and they had a sequencing for how they wanted to talk about them. So in some sense, we're just getting back to where we were back then. So Sander, let me ask you, based in Berlin as you are, what is Europe's role in the global imbalance discussion?
Yeah, thank you. I think the US and China are the key players in the global imbalance debate, China being by far the largest trade surplus and the US being by far the largest trade deficit. And would push back a little bit against Charles that it's only a matter of diplomatic language, although I share that view, but it is also a genuine macro driver of some of the trade tensions that we see, and I think consecutive US administrations have been concerned about this. You might, we talk about that too, you could arguably characterize the global economy as one in which China and the US are engaged in a dangerous dance, where China is ramping up supply and production capacity with debt, and the US is kind of juicing consumption with debt. In both cases, more and more on the public side. And of course, supply has to meet demand somewhere in the global market, and that's where you see basically this big trade surplus and this big trade deficit. Now, on Europe, let me make 3 points. So I think, first of all, despite sort of the trade tensions we've seen across the Atlantic, Europe still has a trade surplus, but it is now dwarfed, really very small compared to China's $1.2 trillion surplus based on the last 4 quarters. And a lot of Europe's surplus is in fact driven by pharma, and there are real questions, speaking of data, about whether that's real trade or it's driven by the tax distortion of a small country next to the UK called Ireland. And so if you take that out, Europe's surplus is even smaller. So it's, to my mind, very clear that Europe is not the driver of these imbalances. It is, however, getting hit by them, and especially by China's big surplus, which is increasingly composed of the kind of goods that Europe is very good at: cars, machines, chemicals. And so there is a kind of pressure on European manufacturing from China's imbalances, led really by a collapse in European exports to China itself. Now, the second point that I think is important to note for the European side is that Europe is actually rebalancing, unlike Asia. In some ways, Europe is the first and only major economy that's rebalancing. The euro has appreciated 10% or more against the dollar this year. It has appreciated a lot against the Asian currencies. And some of that's driven by Germany's fiscal revolution, which the MD in her curtain raiser kind of applauded, I think rightly. So Germany is doing its part to reduce its trade surplus by creating more demand, with a looser fiscal policy focused on defense and public investment, maybe a little bit too much consumptive spending too, but there's change happening. And the third point I would make is that that's not an easy position for Europe to be in. So you're kind of losing external competitiveness anyway, and then your currency goes up, you create a lot of demand that you're providing for the global economy, but the internal demand takes time to kick in, whereas the external adjustment has already happened, and you see that Europe's export performance and associated with that industrial production are under significant pressure. And so there's a kind of time inconsistency issue here that is difficult to resolve, and the sooner Europe gets the Draghi reforms on the table to make sure that demand actually goes into European production, the better. Now, I'm a bit skeptical that the US and China are going to make the macroeconomic adjustments to lower their imbalances. I hope that's the case. I think the IMF is exactly right to emphasize that in their policy advice this week. But if that doesn't happen, then Europe will resort to second best tools, namely industrial and trade policy, and it's actually in some ways already doing that.
Charles, what is your reaction? So Europe is taking steps. It's not clear that China and the US are going to be able to take steps to address the imbalances. What would be your prescription to get us out of this pickle?
My prescription to the US, perhaps we could start with that. I think a bit more certainty would be useful. So the markets have taken Trump's tariffs better than we would have expected. We are in what 1 year ago would have been called the worst case scenario for tariffs. And yet, despite the recent uncertainty and slight jitters in the markets, they seem reasonably confident. Now, I am not going to say that I have had a Damascene conversion and I think that the tariffs as they're currently being practiced will be good for the US economy. I think long term they'll be pretty negative. But they do create an opportunity for the US to reshore some production, hopefully. What I don't see is the investment that makes the reshoring possible. Why is that not there? Because of the lack of certainty. If a firm is expected to invest in the US, whether it's a US firm or a European firm or from somewhere else, they need some certainty on the inputs that they are going to be putting into the production. And I understand the administration's concern that if you give them everything they want on inputs, they'll just put final assembly lines in the US, which some European firms, which I won't name, have done. Just the final assembly line and nothing else. That's something, that does create jobs. But there has to be much more communication and a two-way street between the firms that the US expects to invest between those firms that need to tell the US where they want to invest, which sectors they're willing to invest in, and some certainty on how they can get the inputs in, maybe through some sort of transition, maybe through some exemptions. I think that's very clear for the automobile sector, quite clear for aviation, even for pharma. So that's probably what I would prescribe as a solution for the US. I see the vision. I understand what they're trying to do. And I think it has been caricatured sometimes as this administration doesn't really know what it's doing and Americans are never going to produce their own socks again. That is a caricature of what they're doing. But I think the very reasonable criticism of what's happening is that it's too messy and there's not enough certainty on what you get if you do invest. I'll leave it there.
One follow-up for you on that. So we're hearing Sander talk about Germany undertaking industrial policy. The U.S. seems to be in a position where it's not pursuing industrial policy, at least not in terms of the kinds of investments we saw over the previous 4 years. Would a situation with tariffs and certainty be enough, or does it matter which sector we're talking about?
I think it does matter which sector. Slight pushback, but this administration does seem to do industrial policy, at least as far as taking stakes in companies it deems to be strategic is concerned. And again, I think the reasonable criticism there is that it's a little bit chaotic how this happens. Suddenly the firm that we're all thinking about that makes chips is now partly a US government company, and it isn't quite clear what the vision is here. I can sort of understand why, because chips are very important, and this particular company used to be a US flagship. We need to invest. But beyond that, we're all sort of scratching our heads on what exactly needs to happen. So industrial policy is necessary. Industrial policy is sort of being done, but in a way that is difficult to read. Under the previous administration, we obviously had the more positive vision to the Inflation Reduction Act. This wasn't always liked by European allies, especially the local content requirements, but they came around to it, as we've discussed together, Beth. Some of those subsidies are still available, at least as far as I know. And I think a combination of the tariffs and, yes, a little bit more of a positive vision might deliver more results. One problem that I'm sort of scratching at and I need to verbalize is that this administration has a very different vision on what sectors are useful. So clean tech and green energy, there's a lot of opportunities for Europe here, by the way, but in this administration these are not fashionable words, whereas they were under the previous one. So I think that's where we have this kind of whiplash effect, where not only are we changing the means, but also the sectors that we think are good or not good change, and I think that makes it challenging.
So one area that the Europeans are investing in is clean tech. So what's the landscape right now, merging trade and industrial policy in Europe on the sectors that Charles has flagged that were in vogue in 2024 in the US and are not in vogue in the US in 2025?
It's funny, I think in some ways the Europeans are a bit behind the US, so the focus in Europe is actually very much on clean tech. There's overlaps. There's concern about reliance on semiconductor supply chains in the Taiwan Strait. I think that's very much a transatlantic shared concern. But Europe is actually doubling down in some ways on clean tech industrial policy. There are major pieces of legislation that the Commission has pioneered. The Clean Industrial Act is sort of being rolled out as we speak. And you kind of see it if you look a bit under the hood. And Europe is less, let's say, maybe assertive or aggressive. It's not applying broad-based tariffs. It's also not coming with one large Inflation Reduction Act. But if you look at specific sectors, you see a lot of action on the ground. Let me give you a few examples. So one is in the wind sector, wind turbines, where Europe still has a very strong manufacturing base. And it's kind of hit by Chinese subsidies and competition. It's also getting hit, in fact, by less demand from the US now that the US is going through quite a substantial green lash and wind projects are cancelled. And you see across the board European policymakers responding. Germany recently more or less forced a company to cut a Chinese supplier out of an offshore wind park just a few weeks ago. France just put 11 billion into subsidies for building offshore wind with resilience criteria, in other words, wanting to bring in kit from Europe or allies. And there was a kind of Nordic state capitalism at work when Ørsted, which has lost a lot of, or is under a lot of pressure in the US market, basically got a bailout from Denmark and Norway. So you see this kind of movement, and I think it's also happening on the electric vehicle front, where there's a big debate about whether Europe can steer some of its demand into its own EV production, driven by concern about loss of the Chinese market, about Chinese competition. China now exports at a run rate of 7 million cars a year, which is quite staggering. So Europe is losing export markets. It will also get a hit from US tariffs, which was long. The American market was kind of offset for European car makers. And so I think that you'll see some action there with a kind of very typical European profile. So not hard local content requirements, but very subtle resilience criteria, climate criteria that de facto filter out Chinese production for further subsidies. And the Europeans, I think, unlike the US to an extent, will probably try to bring allies and friends on board, from Japan to Korea to the UK, and maybe even the US. So I think that's the direction of travel you see in a variety of sectors.
I very much agree with that. And with the countries that I know the best in Europe, I see it very clearly that there are things that are not the Inflation Reduction Act, because Europe doesn't have that fiscal capacity. And what was very attractive about the Inflation Reduction Act is that it was a tax credit, it could go very quickly, and it was sort of open-ended, whereas in Europe budgets have to be pre-agreed, and then there's sort of reconciliation between member states because you can't have distortions. So these are all the sort of constraints that Europe operates under, but within those constraints they have done quite a lot. So there are pretty clear subsidies that are available if your battery comes from one place and not from another in France, and you can guess which the other is. So those things have been done. Individual member states have anticipated the deluge of Chinese supply, especially in electric vehicles. And in France's case, they're reasonably satisfied that they've managed to channel demand towards domestically produced alternatives. But I guess my concern is that Europe does move more slowly. There are many good things about that. It is 27 member states that all have their national sovereignty that has to be taken into account. But when you're facing a challenge of this magnitude, I think Sander and I would agree on this, that Europe is moving, but the steps are always quite incremental. And I do also have sympathy with the attempts to make these measures usually WTO compliant. Not all of them are. Sometimes they do things that break the rules, and the US-EU deal is not WTO compliant. They took that one on the chin. But the EV measures are WTO compliant. They managed to investigate the subsidies received by each and every brand coming from based in China. And on that basis, they were able to come up with countervailing measures that had been calculated as fair by economists, which made it all compliant. But that's for one sector. It took 1 year, and it took the teams in the Commission working on this are huge. And so it's going to be difficult to replicate that for all the sectors that need to be protected. So Sander knows Europe better than I do, so I'm curious what you think. But that would be one of my concerns, that I have sympathy with the attempts to make this seem WTO compliant or be WTO compliant. I have sympathy with the trying to avoid being profligate in using subsidies and barriers, but maybe it will end up being not enough.
No, I would agree. I think Europe is a bit slower, and that is costly, right? So if you look at Germany, Europe's most important auto producer, has lost 50%, half of its net car exports in the last 5 years. That is a major shock for the German economy, and you see it everywhere. So all over the newspapers, concerns about having to close plants. There's a lot of social unrest, in fact, from this. And so in some ways, these moves come a bit late for the great car cities of Germany. And so the slowness has a cost. At the same time, Europe is a much more trade-oriented economy than either the US and China. And so there is a real desire to keep as much trade as possible under global rules whilst there's so much pressure. And so Europe is trying to kind of thread the needle of providing that support for some of its key manufacturing sectors without further damaging open trade. And that's a very hard line to walk. And you end up seeing these kinds of drawn-out investigations followed by countervailing duties that on Chinese EVs in this case that were WTO compliant. But Europe is moving. Last year the Commission had 33 trade investigations, I think the highest it's been in decades. 20 of them were about China. The most sort of notable sectors in those investigations are steel and chemicals, where there are also really tough choices for the Europeans. Europe has an energy problem, it has an energy price problem. Steel and chemicals are energy intensive. What's the way forward? I think one elegant way is to let these energy intensive industries migrate to parts of Europe that have a lot of sun and wind, on the Mediterranean, for example, but that too raises difficult sort of distributional questions. But it's clear that Europe is not willing to let these sectors go without a fight. And I would agree with you that the direction of travel and the way in which the Europeans do it is much more by the book, which has downsides, but it also has long-term upsides. I personally think that having some openness to Chinese competition is still good, because it means that your firms feel the pressure to innovate and stay in the fight. But of course, for Europe, it is very important to level the playing field and make sure that the competition is fair and that Chinese companies are not dominating the whole market, because that would lead to concerns about resilience at a time when Europe also needs these industrial supply chains to underpin rearmament, which is just a big challenge. And so steel and chemicals matter because they matter for explosives, they matter for tanks. Having your own battery supply chain matters for drones. So there's a lot at stake here. On your silos point, this is about far more than just economic policy.
Especially when you bring in defense. I have said, I suspect that Europe now having to bear more responsibility for its own defense may fundamentally change its relationship with the WTO. Because once that is on the line, you look very differently at things like local content requirements and these taboos that were built into a system constructed in 1995 in the middle of a very different way of thinking about the world. When we were in office, someone said to me, they worried that the EU was going to go to its grave in a WTO consistent coffin. But that has really changed. Whether we call them incremental steps or major steps, I think it's pretty major for Europe. Charles, what's your reaction to?
Well, to bring it back to the cluster of issues we're covering, there's the currency aspect, there's trade, and there's deficits. So if we're zeroing on Europe, the euro has appreciated against the dollar and against other currencies. Is this bad for competitiveness? It could be, but Europe has to compete on quality, and there it still has some advantages. And then you mentioned the defense imperative, which may or may not involve the issuance of new debt, a new euro sovereign asset. We're really pulling all the clusters together here, but it is important. How is Europe going to pay for its defense build-up? There is a little bit more innovative thinking on this, a little bit more. And so we have 150 billion that may be borrowed by the Commission to fund cooperation between firms and cross-border mergers. This is good. Fund innovation. This is positive. But it's not really at the scale that provides the US with the advantages it has. And I don't think anyone's being unrealistic. So in April, Sandra and I, when we were here during the spring meetings, heard all sorts of things about the euro replacing the dollar, and this being, suddenly Europe's moment. And a lot of those things at the micro level were true. People were looking for alternatives to the dollar given the uncertainty. Another buzzword, we've used this. The euro seemed like a pretty good second guess, or second currency after the dollar. But there weren't really enough buckets to put your cash in. So defense is one way, and it brings us back to these sort of national security concerns. So will Chinese institutions pile their cash into European assets that are going to fund a European defense builder? And we've lived with these contradictions for quite a long time. This is how the US has managed to fund its deficit for a long time. Will this happen again for Europe? There are some reasons why you think, maybe, because China does need to put its huge piles of cash somewhere. But that's another sort of external piece of pressure, and another means that pressure can exercise China above us. As this reception starts, I'm losing my ability to concentrate. But I think that point made sense, that in some ways these contradictions have worked for a while. We've managed to live with them, that China has invested in US debt, which has allowed the US to fund its defense spending, and people have been okay with that. Will this happen again for Europe, and will it stay the same for the US? I think there are reasons to doubt that, which should be concerning.
Yeah, of course.
So I agree with this barrel of contradictions being there. I think for you, one point is that Europe doesn't actually have an external financing problem. It is a surplus. At least the Eurozone is a surplus bloc. Italy, often gets criticized a lot in European debates, but it's a trade surplus country. So is Germany. And so there is, real potential for Europe to fund itself to a degree by bringing some of the savings it sends into the world back home. For example, to basically pay for this rebuilding of the military capital stock. Now, over time, maybe Europe will change into a small deficit bloc as it ramps up investment. But for now, that's not really the case. And that's a major point that Mario Draghi and Enrico Letta always make, is Europe sends a lot of savings into the world. It can also put them to work at home in investment. My other reaction is I think Europe has kind of chosen already how it's going to do the defense funding, and it's largely national. There's the 150 billion in commission loans that 20 or so member states are using, so it's quite popular. But the bulk of the defense spending will be done by national budgets, which brings us to debt. It is pretty clear to me that the ones that will be driving the defense ramp up are the countries with the most fiscal space and the ones that feel the threat from Russia the most. And so you have to think Poland, Germany, and the Scandinavians and the Netherlands, all of which have fiscal space, all of which feel that urgent need, will be really driving a lot of the spending. And thus, in turn, also, I think, determining more than, say, France or Spain or the UK on the outskirts of the EU, what the money gets spent on, what the defense industrial policy looks like. Because if you pay the piper, you play the tune. And so I think it has pretty profound implications for European politics, where the center of gravity in Europe is going to start moving north and east, because that's where the locus of security will be, and that's just a question of fiscal arithmetic.
So it feels to me, and I'm curious if you agree or disagree, that there are very tectonic shifts happening across all of these dimensions, whether it's trade and the way we designed the rules in 1995, which is different from the original conception in 1948, whether it's dollar dominance, even if that is sustainable in the short term, workarounds that countries are starting to explore in an even more important way, changes in demand versus export-led growth. Are we looking at something as fundamental as the conversation that was happening in 1944, or are we still fairly far away from that?
I think the issues are on a scale similar to at that time. The big shift. We haven't, thankfully, had a world war that we're recovering from, but there is a need for a new paradigm, and I think everyone accepts that, whether they're still wedded to the old paradigm or not. I think at this point everyone accepts that there are these big problems that we all need to talk to each other about. The reason I'm skeptical isn't so much the need as the possibility to reach any kind of agreement. So in 1944, 45, you did have a world that was split, but you had a dominant side on the West, which had a much more dynamic market, that was able to set the rules, not for the whole world, but at least for the terms of trading for countries that were willing to trade with the Western Bloc. And now while I'm meant to be optimistic in my job and the GeoEconomics Center is meant to come up with solutions, there's this big barrier in the road that I don't see the political will to come up with a new paradigm. But maybe you're more optimistic.
No, I mean, I think we're in a time when there's very little international coordination, and that is a concern, like I was saying. I think the IMF's recommendations on how to fix this global imbalance problem with all the effects on debt and security that we were discussing are sound, but do we believe at this table that China and the US, which are on a very tense footing as we speak, are going to do that kind of coordinated adjustment? It seems unlikely. And so for now, I think we're not going to see the rebirth of an international system, but you see on the European side, I would say, two sources of optimism. We live between fear and hope. But one that I would mention is that the Europeans have succeeded in stabilizing, to a degree, the transatlantic relation, which was important to make sure that the US does not pull its support from Ukraine completely, including things like intelligence and strategic enablers that the Europeans don't have yet. Now, that came at a cost, an US-EU trade deal that's very unbalanced, but Europe paid that price and gave itself some time to do all the things we were discussing. And the second reason, looking into the future, that I'm a bit optimistic, and I think often underestimated in the US, is that Europe has a far larger manufacturing sector than the US. It's 16% of European GDP, it's 11% in the US. Europe produces more steel, planes, vehicles, everywhere you look. And so on the transatlantic front, I wouldn't be surprised if the US and Europe over time grow closer together, because the US will need some of that European supply. And Europe, for its part, still needs a lot of American tech and security.
And then on the US side,
and how the US deals with China, No, I mean, it looks quite gloomy, and the news of the past week has confirmed that. But then, never underestimate the attractive power of a deal, or the power or attractiveness of a deal. So we all know some of the things that President Trump wants, and he wants to make sure China buys some agricultural products from the US and a few other things. That deal is still there, even if the current conversation seems quite negative, although then President Trump did tweet that actually it could be okay. So we'll see. Hopefully there is still a meeting in South Korea soon. But I think these deals will be extremely small. The idea that we have an abstract conversation about global imbalances, I think, seems quite remote. But smaller deals are available, hopefully.
It does seem like we're witnessing the various choke points that have made their way into the system over the last 40 years, and the major powers deploying those choke points in tactical ways, which I think is what you're saying. Therefore, we're going to have some small deals before we eventually figure out what we're going to do in a more systemic way. Maybe that's a good place to end it. Thank you both so much. I learned a lot from this, so I appreciate it. Thank you.